Picture a plane in a submarine. The plane is flying at altitude and everything is fine until a storm rolls in. The turbulence hits, the plane shakes, sometimes it can't take off at all. The submarine is operating completely underwater. When the waves surge on the surface, the submarine doesn't notice. It doesn't know there's a storm. That's what uncorrelated assets mean. And most investors have never been taught to build a portfolio that includes both. I'm Dani Lynn Robison, founder of Freedom Family Investments, and I've worked with accredited investors for nearly 2 decades. And one of the most consistent patterns I see is this: high earners who believe they're diversified because they have a brokerage account, a 401k, stock options, and maybe a mutual fund or two. But when you look closely, everything is on the same plane. Different shapes, different colors, flying at different altitudes. But when the weather turns, they all feel it at the same time. In 2022, the S&P 500 dropped 19.4%. A diversified bond portfolio dropped at the same time. A so-called balanced 60-40 portfolio, stocks and bonds together, lost 15 to 20% because the two assets that were supposed to protect each other moved in the same direction. That's not diversification. That is concentration with extra steps. Needs-based real estate did not move the same way. People still needed housing. Rents did not drop because the market did. Multifamily rental households reached an all-time high of 22.4 million in 2025. The demand driver was not market sentiment. It was a simple fact that people needed a place to live. That is what uncorrelated means in practice. Not that the investment is risk-free, but that the thing driving its performance is completely separate from what moves the stock market. Now here's where your financial advisor comes in and why this matters. Most financial advisors operate entirely in the plain universe. Their platforms, their products, their training, and their compensation are built around public market investments: stocks, bonds, ETFs, mutual funds. These are the tools they have. And in most cases, they're genuinely good at working with those tools. But private real estate debt? The kind of investment where your capital lends to a real estate operator and earns interest regardless of what the market does, is not on their platform. It doesn't even pay them a commission. It lives outside the system they work inside. So they're not hiding it from you, they simply have no mechanism to recommend it. Harvard, Yale, and Stanford endowments have maintained 30 to 50% allocations to private real estate and alternative assets for decades. These are institutions with the smartest money managers in the world. They have been deliberately positioning capital in assets that do not respond to the same storms as public markets. They're building portfolios with planes and submarines. Your financial advisor is probably not doing that for you, not because they don't care, but because the system they work inside was not built for it. Here's a few questions worth bringing to your next conversation with them. How are you compensated on what types of products? Do you have any personal experience investing in private real estate? How do you think about uncorrelated assets and risk balance in a full portfolio? And have you ever worked with clients who hold private placements alongside their traditional investments? You're not trying to put them on the spot. You're trying to understand how much of your financial picture they're equipped to see and where you may need to do your own research. One more thing worth knowing. There are legal structures through which financial advisors can be compensated for referring clients to private real estate investments. Not all advisors are set up for this, but the ones who are can serve as a real bridge between traditional portfolio management and alternative assets. If you have an advisor you trust, that's a conversation worth having with them. We work within those structures and are happy to speak with your advisor directly if that would be helpful. The goal is not to replace your advisor. The goal is to make sure your full portfolio includes more than one type of asset, so that when the storm hits, not everything is flying at the same altitude. An investment that does not know there is a storm may be one of the most valuable things you can add to your financial picture. In one of our next videos, we get into the specific questions you should ask any private real estate operator before you invest. The ones that separate real operators from hype. Go to chatwithfreedom.com if you want to talk through what a submarine looks like in your portfolio specifically. I hope this was helpful, and I hope we have the opportunity to work together.